What's up everyone, my name is Ale. Welcome back to my world of stocks and welcome back to my stock market monthly update series for the month of September 2023. In each episode, I give you guys an update on the current state of the stock market and really the economy as well by splitting the video up into three parts. In part one, we cover any of the current performance of the stock market and just take a look at how everything is going so far. Then in part two, we cover any broader economic news and updates that are affecting the stock market, which of course lately all eyes have really just been on the economy and inflation, interest rates, recession fears, all that kind of stuff. So I'll be giving an update on all of it and sharing my opinion and where I think things are heading in the near term and longer term as well. And then in part three, we just finish up with the biggest gainers and losers of the past month and see what individual stocks made the biggest moves up or down and see if anything is worth picking up. I cover any individual news there too. So it's just a lot of fun. By the way, of course, as always, I'll be leaving timestamps down below in case you want to jump to any specific part. But I hope you're enjoying the series. I love doing this. It's one of my favorite series because I get to give you an update on the stock market and the economy every month. It's just a ton of fun. But with all of that said, let's just go ahead and dive straight into it. Let's go ahead and start with part one. All right, so when looking at the stock market's performance, August was a pretty lackluster month as all three of the major indexes fell by just around 2% each. However, the overall year continues to be very strong for stocks, with the S&P 500 now up over 16% year to date and 55% in the past 5 years, while just barely being down about 6% from its all-time high. The tech-heavy Nasdaq has also seen fairly similar performance, but I would say by larger swings, having now climbed over 30% year to date and 75% in the past 5 years. However, it's also down a bit more from the top at almost a 15% decline, but still pretty solid performance there overall. And that's going to turn us over now to part two for any market and economic news, as the stock market performance has been very heavily tied this year to the lowering of inflation. And you can see the correlation here as we've now dropped from over 9% inflation at the height of it last year all the way down to 3% in June of this year. However, July actually showed a rare uptick where it broke a 12-month streak of decreasing inflation as it actually climbed by, climbed up to 3.2%. And by the way, August numbers should be coming soon in about a week from now, and some projections are already hinting at yet another increase to inflation of 3.8%, which is a bit alarming. And as such, the Fed continues to raise interest rates to combat that inflation, which now sit at the highest level in over 2 decades. For its part though, the Fed Chair Jerome Powell recently affirmed that they no longer expect a recession to occur as a result of all of their recent interest rate hikes. However, I think that's a pretty bold claim to make considering a number of factors. First of all, any time that we've raised rates this sharply in the past, it's typically resulted in a major recession and stock market crash. And as you can see on this chart here, this most recent period of rate hikes is actually sharper than really any of those previous ones in recent history over the past, several decades or so. Now, the next Fed meeting, by the way, will take place later this month. But while interest rate traders are now pricing in a whopping 93% chance that the Fed will keep rates as they are in the next meeting, the fact is that inflation is still hovering quite a bit higher than the Fed's target rate of 2%. And if it doesn't get down there more quickly, or especially if it continues to rise, then you can be sure that the Fed will keep our already very high rates elevated and maybe even raise them even higher. Now, the reason why this concerns me is because the economy is already on thin ice as it is. So if we continue to add more weight to it, keep raising interest rates, keep them elevated, well, I think the ground could give way to another recession at any moment. And here's a few reasons why. For one, the jobs market is slowing down considerably right now, with August unemployment unexpectedly rising up to 3.8%, which is the highest it's been in over a year and a half. While August payrolls also increased by only 187,000, which is dramatically lower than the 271,000 average that we've seen over the past year. And while it's still hard to envision a recession when jobs are growing by so much, you have to remember that we are technically already in an earnings recession, with official second quarter EPS coming in at over a 4% decline for the S&P 500, marking the third quarter in a row, third straight quarter of shrinking profits, meaning companies are already feeling the pain. So who knows how long they're going to, keep hiring for jobs. And while our national GDP has still been positive so far this year at around a 2% gain in Q1 and Q2 respectively, you have to remember that this is being compared to an actual recession last year. So this year should have actually been an extremely easy comparison, and yet we know that companies are still struggling to grow. And by the way, the second half of last year was also much stronger, so who knows if a recession doesn't actually hit soon, going into next year. In fact, there's already several other indicators hinting at a possible recession happening soon as well. For example, the New York Fed's highly regarded recession watch tool is currently at the highest reading in over 4 decades, showing over a 60% chance of recession, which anytime that it was around just 30% or more, a recession actually hits. On top of that, the yield curve is still at its biggest inversion level in over 4 decades too, which since the late 70s, the yield curve has inverted 6 other times, with every single one of them preceding a recession. And while investors seem to be dismissing all of these warning signs and sending the stock market higher, CNBC is reporting that over 90% of CEOs surveyed are actively preparing for a recession as well. So all of this is pretty alarming to me. Now, whether a recession actually hits or not, it's not the biggest concern of mine, because as an investor, I actually welcome recessions. I mean, I think they're a healthy part of our economic cycles. They can clear up a lot of congestion. And of course, they also lower the stock market by a lot, which at present time, I do think that the stock market is trading way too high considering our economic conditions. And so I think that that would present a great buying opportunity, because the Fed is just going to lower interest rates anyway, which will send the stock market skyrocketing once again. I know a lot of people disagree with that, but it's my personal opinion on it. From an investment standpoint, I think recessions are not something to be feared. Obviously, more broadly speaking, it causes a lot of damage. A lot of people lose their jobs. It can cause a lot of pain. But again, just from an investment standpoint, assuming that you're in a good situation, I don't necessarily think that it's something to be feared so much. But regardless of any of that, all we can really do at this point is speculate on whether any of this will actually occur. So what I think we can really focus on is to just make sure that we're buying the best available stocks out there at the best prices. This is not the type of environment where you want to be chasing, really expensive, highly valued stocks. You more so want to be looking for the better discounts out there and the safer stocks. And I will say that there is actually a ton of stocks that are still extremely undervalued out there in the market. And there is a lot of risk too. So you kind of have to balance it out. You have to look for opportunity, balance out the risk with the value. But overall, I'm still buying stocks, but I would say on top of that, it's very important to make sure that you have substantial savings, because at the current state of the economy and the stock market, I do think that there's going to be volatility going forward. And if we do happen to have a big drop, correction, crash, anything like that, that's where you want to do the majority of your buying. So right now, I'm buying slowly in small amounts where I see opportunities, and there are opportunities out there. But if things go south from here, and especially in a bigger drop, then I want to make sure that I have the savings to buy much heavier into those drops, which is going to just go ahead and bring us to part 3 now, the biggest gainers and losers of the past month. And we'll take a look at some individual stocks here. I will just say though, please keep in mind that when we talk about the biggest gainers and losers every month, these are some of the most volatile stocks because they're moving up and down by huge amounts. These aren't necessarily the best stocks to be investing in, so just kind of keep that in mind. You do, of course, always want to be investing much heavier into safer, more reliable stocks that are not as volatile. But, sometimes we find some hidden gems here or there, so I still love to cover these every month. So let's just go ahead and take a look. Alright, so starting first here with the biggest gainers, and usually I like to look at the losers a bit more because Those are the more interesting stocks. Their prices are actually going down, but we'll still look at the gainers as well, see if anything stands out here too. And right off the bat, the first one I notice here is Celsius Holdings, which climbed almost 40% this past month, and that's a very popular energy drink company that has seen explosive growth on the top line, more than doubling their sales last year. And given the rising trend and popularity of the energy and sports drink market that is growing larger every year, most investors think that Celsius will likely have a very bright future as a company. However, as a stock, it's already up over 90% this year and over 4,000% in the past 5 years, with just as rich of a valuation as you would expect, trading over 400% more expensive than the sector on adjusted earnings and still about 1,000% higher on sales too. So I'll be staying away from this one myself. And actually, this is a pretty good example here of what we talked about earlier, not chasing any super expensive stocks in this horrible macro environment, but rather, looking for better deals out there. But besides that, the legacy computer company Dell rose about 30%. I've never really been a fan of Dell computers myself, so it'd be hard to invest in that company. But we also had US Steel rise about the same amount. Really just a pure play there on the American steel market, but it's a bit too volatile for my taste, with lots of swings up and down, and yet it's still, about flat over the past 5 years. So it's not too exciting for me, especially as a long-term investor. But some people do like to swing trade that one for that volatility. I can definitely understand why. But we also had the giant biotech pharmaceutical Eli Lilly climb 24%. And while I do think that it's a solid long-term stock, I just think there's better options out there at today's prices, given that it's already soared by over 400% in the past 5 years to a new record high, with a super rich valuation of a whopping 58 forward PE ratio. I'd much rather buy something like Bristol Myers Squibb or Pfizer or even AbbVie, who are all extremely cheaper while also paying much bigger dividends of around 4% or more versus Eli Lilly that only yields less than 1%. Scrolling down the list though, the cybersecurity specialist Okta climbed over 20%, but I like Palo Alto, CrowdStrike, and Fortinet a lot more. And we also had PDD Holdings rise 15%, which I actually just made a video on it recently for my Stocks My Viewers Want Me to Review series. And I really like them as a speculative Chinese stock that owns the popular shopping app Pinduoduo, as well as Temu, which is a high-flying international shopping app that is rivaling other apps like Alibaba's AliExpress and was even the most downloaded app of this year at one point. However, I never purchased the stock because I already own a few Chinese stocks as it is, which I try to limit my exposure to. But considering that it's still down, close to half its value from the top, I do get tempted to buy in on this one sometimes, and I recommend my video review on it if you want to learn more about them. Apart from that though, the popular online shopping platform Shopify rose about 15% too, but I think Amazon is a much better buy overall. The toys and games giant Hasbro also rose another 14% on better than expected earnings, which I've always wanted to like that company because they have some pretty cool brands, including Nerf, tons of board games like Monopoly and Dungeons and Dragons, and they even own Magic, which is one of my favorite trading card games to play. So I've always, been interested in the stock, but I've just never really understood why they trade so damn expensive as if they're a growth stock when sales are actually falling this year by 5% and are expected to be flat next year too, yet the PEG ratio is more than double the sector. Doesn't make any sense to me, but I wish it was, much cheaper because I've always just wanted to own that stock. It's just so expensive though. I can never, convince myself to pick it up. Just to finish up though here with the gainers, there was 3 pretty cool stocks here as well that all rose over 10%, including the cybersecurity specialist Palo Alto Networks, the language learning app Duolingo, and the tax filing and finance specialist Intuit, who of course owns TurboTax and has a really sticky business. I do like that one. All 3 are trading a bit expensive right now though, but my favorite of the bunch is still Duolingo, which is the only one on here that I actually own myself too. And as I covered in my earnings recap video, they had another breakout quarter with the introduction of new AI features that Wall Street is really excited about. Long term, I think they'll be a winner, but the stock has already more than doubled this year, so I'm not buying any more shares at this time, but it's still one that I enjoy holding long term. Okay, it's time to finish up with the biggest losers, and right away I can see on here a few popular spec stocks in the fuel cell company Plug Power, the Chinese electric vehicle company NIO, the gaming company Roblox, and the online pet retailer Chewy, which all fell over 20% this past month. My favorite though is easily NIO, who I decided to pick up after seeing it crash from over $66 a share down to just $10 today. And I'm not saying that I expect it to return back up to those really high levels, but even if it doubles or maybe triples from here, I'd be super ecstatic. And while it is pretty high risk, it's also just such an impressive company with beautiful looking cars, amazing technologies like their autonomous driving platform that uses a combination of ultra long range LiDAR, high resolution cameras, and their new Atom AI supercomputer for vehicle intelligence, which they even partnered on with NVIDIA. I also see a lot of future promise for their battery swap service, which recently hit over 20 million swaps earlier this year, and after crossing 6 billion miles driven, a recent survey showed that the majority of NIO drivers prefer using battery swaps over a charging station for all of their trips because of how insanely faster it is. And I like how aggressive they are at expanding internationally too, while they continue to build cheaper cars for the mass market. I think there's huge potential there, and the price looks right to me, so I'll be buying in small amounts, if it continues to fall like it has. It's been falling by a lot. Apart from that, though, a bunch of retail stocks have been getting hammered in recent months, with Walgreens, Dick's Sporting Goods, Dollar General, Tapestry, and Dollar Tree all making the list here at over 20% declines over the past month. And even other giants had a horrible August, like Best Buy falling 8% and Target falling over 7%, which they also fell over 20% a few months back too. And the reasons for all of this horrible performance ranges from things like the macro economy, a lot of headwinds there, forcing a lot of these retailers to put much of their products on clearance, which is also hurting their margins. There's also consumer boycotts, especially in the case of Target. There's companies even dealing with higher theft recently in certain parts of the country as well. So it's just a broad range of difficulties that a lot of these companies are facing. Now, most investors that are interested in these stocks, I would say, are probably buying Target the most, given that they've already lost over half its value and are trading at a very cheap valuation, about 44% cheaper than the sector on a PEG ratio basis. And Target was always, kind of a beloved stock back in the day, with also one of the best dividends out there that's been grown for over 5 decades in a row, and it yields over 3.5%. So it's always been known as this really strong dividend payer in the market. However, my pick would actually be Walgreens, who is also down a gigantic amount, and they fell even more recently after the CEO left the company. But the valuation is even cheaper now than Target's at about a 70% discount to the sector, while the dividend is yielding a mind-blowing 8.2%. That is so high. Of course, they have their own unique challenges, and I'm not even certain that the dividend is really safe at this point. But with just a 46% payout ratio and over 4 decades of growth, I think management would be making a mistake to cut that dividend. We'll see what happens, but this is still a very profitable company that is even managing to grow sales by almost 5% a year during a horrible environment, so I've been buying the stock in small amounts. Okay, we're running low on time here, so I'm just gonna rapid fire through some of these last ones. Scrolling down the list, nothing really too exciting, but we did see a few more Chinese stocks fall because China is just really getting hammered right now with their economy and all the geopolitical tensions. But my favorite would still be Alibaba, and they didn't make the list, but that's a stock that I've really liked. We also saw Palantir fall by over 16%, despite what I actually thought was an excellent quarter. You can check out my earnings review video if you want to learn more about it. But to summarize, They did slightly miss expectations, but sales and profits grew by over 12% and 115% respectively, which is very strong. And despite the horrible economy, they still managed to increase their customer count by almost 40%, which shows just how valuable their AI data management services have become. And I think long term, their new AI platform will only improve these services even further as they maintain really strong margins too. Now, this month's pullback was probably because the stock is just already up so much. It's up over 130% this year, even with this recent pullback, which is why I stopped buying the stock myself. But it's still a stock that I plan to hold super long term. And if any bigger dips come, I'm probably going to start buying it again too. I do really like that one. And then scrolling a bit further down, the media and streaming giant Paramount fell double digits, but I think Disney is a better choice there. And a little further down from that, we had the bank Citigroup, the retailer CVS, and the legacy motor vehicle company GM, General Motors, all fall close to 10% each. The only one that I kind of like on there though is GM, who's now trading at about the same price it did a decade ago with a dirt cheap valuation, despite what I thought was actually a fantastic second quarter, growing sales and profits by 25% and 51% respectively. And long term, I just think they have some pretty strong brands that can help them break into the EV market too. So I'm buying a tiny amount here. It is risky, but I also just kind of feel like it could be a value turnaround play, so that's what I'm hoping for. I'm buying it in small amounts. I'll go ahead and stop right here, though. I hope that you've enjoyed this month's update. Please share your thoughts down below on everything that we've discussed. I'd love to hear from you. I'll try to respond to all the comments I can, and we can have a quick discussion. Thanks for supporting the channel. If you don't mind subscribing, hitting that like button really helps out a lot. If you want to go above and beyond, please click on the Patreon link down below or join on the YouTube memberships join button. And you can help sponsor the channel and get access to our exclusive Discord, which I'm looking to add more features to in the coming months. So I'm trying to get as many people signed up for that as possible because I really just want to build a big community on there of us like-minded stock market investors. So if you don't mind supporting me on there, it means so much to me, and I'd love to see you on there and have some fun, chatting about stocks and hanging out together. But anyway, with all of that said, thank you for everything, guys. I hope you're all doing well, and I will catch you in the next video. Take care, everybody. Bye-bye.